Joining us right now is the Chief Investment Officer of E-Valuator Funds, Kevin Miller. Kevin, good to see you this morning. Thanks so much for joining us.
Good morning. Thank you for having me.
Are you seeing a change in sentiment on the part of your investors or in terms of money flows, given this new worry about higher interest rates in the market?
Yeah, well, what we do, Maria, is we manage 5 asset allocation funds. And so on our lower risk side, we're seeing shareholders start to become concerned about the rising level of interest rates. We have a baby boom generation that, for the most part, is well over halfway retired, and they're looking for how can we generate earnings and how can we generate income off where interest rates are going. And from that perspective, we've been very fortunate to take advantage of bank loans and ultra short on the quality side, and then we also been using some high yield. So there has been some concern with our shareholders on the equity side. We've made a lot of good headway with small caps so far this year, but we see that starting to taper off going into 2019 for small caps domestically.
So it sounds like sentiment has gotten lower. Sentiment has gotten a little more negative facing stocks. That's what we see, obviously, from the numbers.
That's correct, yeah. And what you're seeing is also not only a slight pivot from equities into fixed income, but you're also seeing more movement away from growth-oriented stocks and going more into something more dividend-oriented. We're at an interesting point where investors are contemplating, is it worth staying in the equity markets when you can start to get a yield, a 2-year that's right now it's about 2.8, but right. Get up close to 3%. They're starting to look at that transition point.
And that's the question, right, Dagan? I mean, do you want to have safety in treasuries and get almost 3%, or do you want to have the risk of the stock market? And that's why we're seeing this disruption in markets, with the 2-year up to almost 3% right now.
And Robert Wolf pointed out last week what you can get in municipal bonds. Like, it's a tax-free return. When you adjust for the tax effect, you're looking at a yield on some municipals of like 6%.
That's competitive.
So, so again, the yield at this level is more attractive. If it goes any higher, you definitely, so there are a number of reasons why stocks sell off when yields go up. Number one, treasuries are more attractive. 2, you also have the like that directly impacts the value of those future earnings, particularly in these treasuries, because that, I mean, in these stocks, that's how you calculate what a stock is worth at the present day. And then also the Wall Street Journal has a really interesting story about how U.S. stocks have finally caught up with the global markets. You have the emerging markets deep in bear market territory. It's been a rout around the globe. The U.S. until recently seemed immune to that, and now we're falling as well. So maybe that was those markets were the canaries in the coal mine, so to speak, telling us what to expect here in the United States.
Yeah, meanwhile, though, you have a very good backdrop still. Here we are in the third quarter earnings kickoff, and you're expecting, and we're expecting 21% profit growth for the S&P 500, Kevin.
Yeah, that's correct. I think, this is a real good opportunity for us at our funds. What we did some tax harvesting. I don't see this as a prolonged pullback. With inflation at 3.7%, unemployment at 3.7%, inflation at less than 3%, we've got opportunities with a consumer-driven economy that I think we're still going to finish the year on a strong note. It just isn't, it's going to depend, the future, 2019, it's going to depend on what the Fed does. Obviously, they want to get their rate up to 3.25% to 3.5% to normalize it. I would like to see them climb that like as if they were climbing a mountain, where they go up and then they cap a little while and then they increase some more, as opposed to climbing it like it's a staircase. And it's nice that they're only increasing a quarter point per quarter, but yet that it takes 4 to 6 months for that rate increase to work its way through the economy, and we're getting to the point where it's getting high enough where people are taking time to decide whether they should be in equities.
Yeah, they're noticing the move, Lee. I mean, when you have a rate that has moved up the way it has, you notice it.
Yeah, people are definitely noticing the move, but they're also noticing what their balances are in their 401k over the last couple of weeks, or at least the last few days. And the thing that I found really remarkable is that voter sentiment on the economy, on how things are going, is really tied so much directly to how the stock market market's been going. Even though people said the world was going to end after the president took office, the market took off, voter sentiment took off. One of the things I'm looking at right now, though, is this is this blip going to have an impact on the midterms, on people's feeling about the economy? And so when you say you think we're going to end the year strong, when do you think that things are going to bounce back?
Well, I would expect things to turn around. We're in the midst of earnings seasons, like Maria had indicated already. We're expecting over 20% year-over-year increase. I think we're going to see our financials actually come back, even though last Friday, some of them that reported started off the day good, and then they kind of fell apart toward the end of the day. Something that's probably going to influence our markets in the very short term is what's happening overseas with Saudi Arabia and Brexit. But again, we have consumers where inflation is not up. We have a little bit more money in the pocket, and I see us having a very good play out into the holiday season. Unemployment is not, the fundamentals just haven't changed that much.